Hey everyone, it's Karthik with MoneyVest. So I've got a very important and data-driven video for all of you. So in this video, we are going to be discussing exactly whether rate cuts are bullish or bearish for the market, what to expect moving forward, especially now that Jerome Powell has fully indicated their openness and the idea of potential rate cuts coming in later this year, most likely next month in September. So we discussed this in our live stream and our market update as well. But this is the spreadsheet that I've been working on. So this is, again, a little bit of an extension of what we have already discussed. It's taken me a lot of time to basically go back to all these specific dates, manually look at S&P 500 and where it's been trading and the peak and the trough. And I've added this right here, which is the S&P 500 returns on a 1 month, 3 month, 6 month, and 1 year basis after the first rate cut. So we're going to draw a lot of conclusions from this spreadsheet. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. And all I'm asking in return is that you share this video with your friends and family and your other traders, investor friends that can benefit from all this data point. And we can do a full comprehensive analysis and we can understand better based on historical data, what does a rate cut indicate for the market moving forward. So this right here, Federal Reserve Chairman Jerome Powell indicating interest rates that are going to get cut ahead. He said, and I quote, "The time has finally come for policy to adjust." So the time has come for policy to adjust and the direction of travel is clear. And that direction is very clear. In other words, it is downward for interest rates. And the timing and the pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. So a couple things right off the bat here. The direction is clear, meaning that we already know that rates are coming down. We just don't know when. So the timing is uncertain. And to at what extent, right? Timing and pace. So in other words, when we're going to see rate cuts and to what extent we're going to see rate cuts is still open-ended. But we know that they are coming. And that's where the direction is. With markets awaiting direction on where monetary policy is headed, Powell focused as much on a look back at what caused the inflation that led to an aggressive series of 11 rate hikes from March 2022 through July 2023. That's exactly what we have over here. March 2022 is when they essentially started. All the way to August 2023 is where they kept interest rates. This is including for pauses. And they raised rates by a whopping 533 basis points. That's the ending rate. And the overall rate increases were well over 527 basis points or 5.27% for a total of 29 months. And September 2024, of course, we've got question marks here. That's the market's performance. But this is September 2024, the most likely anticipated rate cut from the Federal Reserve. Inflation has declined significantly. The labor market is no longer overheated and the conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized and the balance of risks to our two mandates has changed. And we will do everything we can to make sure the labor market stays strong. And again, the progress on inflation continues. So again, that's their dual mandate. Keep making sure that inflation is coming down and well within that 2% range. And at the same time, making sure that unemployment does not get out of hand. So I've been back to as far as 1957. And I've got here the first cut month, right? So the month when they actually made the first cut. And you can actually see that from the data here. So what I have is the S&P 500. And this right here is the federal funds rate. So just so you understand how I'm doing this analysis is when I'm essentially taking into account the first time the Federal Reserve decided to cut interest rates after embarking on this overall journey of raising interest rates. So for example, to give you a little bit of perspective here, this right here, you can see that interest rates back in 1957 up until October were just over 3.4%. And then if you take a look at this, right, so coming from October to November, all the way to December, all the way up to as much as June of 1958. So this right here constitutes as a rate cut. This is what a rate cut basically looks like as interest rates are coming down. Same thing over here, same thing over here, same thing over here, so on and so forth, right? So every time you see that effective federal funds rate coming down, I've essentially taken into account the market's performance 1 month, 3 months, 6 months, and 1 year later. So here's how the markets have done. 1957, 1 month and 3 month performance, negative. 6 month and 1 year, very strong. This was also accompanied by a recession. So if you come over here, the peak to trough, we were down over 21%. Again, this right here, we were in recession for a full 243 days or just over 8 months. If you come over to May 1960, almost 2% increase after 1 month, 1.83% 3 months later, slightly down 6 months later, but up 19% 1 year later. Now, in most instances, again, you can kind of, pause the video, take a look at the data yourself if you want to. But what I've really understood and try to extrapolate is the market tends to be a little bit more volatile after a rate cut on a shorter time frame, meaning 1 to 3 months, especially if it's accompanied with a recession. So really the question here is not the market's performance during the first rate cut or market's performance after a rate cut. The question here that we need to be asking ourselves is whether there is going to be a recession in the first place or not. Because if this rate cut does not accompany a recession in the US, then I can confidently say the markets are actually going to do much better. And this is going to lead to a more quantitative easing, thereby leading to more market potential and momentum higher. Because I've highlighted 3 instances where the Federal Reserve was cutting interest rates without a recession. In other words, there was a soft landing, and that was in 1966, 1984, and 1999. So as you'll notice that all 3 of these dates are blackouts, meaning there was no recession around that time. And when the Federal Reserve was cutting interest rates, which is highlighted by these green dates. So we got December 1966. So I'll highlight that here. So we got December 1966. Then we've got September 1984. That's going to be over here. And then we've got October 1998. So those 3 times we were not accompanied by a recession. And if you take a look at market's performance, all 4 categories were green, meaning that we were higher 1 month later, 3 months later, 6 months later, and 12 months later. In other words, 1 year later, we were higher. In December 1966, almost 8% to as much as 20% 1 year later. In 1984, we were basically flat 1 month later, but then up almost 10% 1 year later. And then October of 1998, 5.9% 1 month later, and up almost 25% 1 year later. So the lack of recession actually leads to a much stronger market momentum after the rate cuts begin from the Federal Reserve. With the recession, we have been a little bit more uncertain on shorter time frames. But if you go up to as much as 1 year, the probability has been very high. Going back as far as 1957, the only two times when the markets were red, even 1 year later, was in the dot-com bubble and the great financial crisis of 07-08. So December 2000 and August 2007, that's the 2 times the Federal Reserve decided to cut interest rates, and we were down, 3 months, 6 months, and especially 1 year later, down double digits. 1 month later, we were still up, but we were down 1 year later because those bear markets and those crashes ended up being more brutal because in both instances, we were down over 50%. So this is the peak for the market back in March of 2000, ended up a trough in October of 02, down over 50%. And then if you come take a look at 07, October 07 was the peak for the S&P 500. March 2009, so almost 2 years later, we were down over 57%. So those are the 2 main instances where the markets were down significantly, even after the Federal Reserve started cutting interest rates. 1 year later, we were down quite significantly. Now, this right here is actually quite an anomaly. And the reason for this is because even though we saw rate cuts begin in August 2019, and it was accompanied with a recession. It was the shortest recession ever to be recorded, one of the shortest, and the markets were green across all time frames. We're talking 1 month, 3 months, 6 months, and 1 year later, up anywhere from 1 to as much as over 20% because the recession only really lasted for 2 months, and the rate cuts were quite aggressive from the Federal Reserve, dropping them down to as much as 0%. So you'll notice the ending rate was 2.33% in April of 2019. So they held those rates until August is when the first cut happened, and then they dropped them down to pretty much 0%. That's when they started again in March of 2022. So this spreadsheet is actually quite exhaustive in a sense that it actually tells us everything that we need to know from a rate hiking cycle. When was the first rate cut? When did this start? What was the ending rate? What was the ending date? This is S&P 500's performance. This is all the recessions recorded in the US, and this is market's peak to trough rates for S&P 500. So really, what I'm trying to extrapolate from this is the average and the median returns for the S&P 500. If you consider all the instances the Federal Reserve has cut interest rates, 1 year later, they've been higher by over 10.8% and 14.6% median return, with the probability for us to be green 75% on a 1 year basis. 58% on a 6-month basis, 50% on a 3-month basis. So it's a bit of a coin flip on a 3-month basis, and then 57% probability for us to be green on a 1-month basis. If we exclude for the dot-com bubble and the 2007-2008 financial crisis, because I think those two instances were unique in their own ways, because the dot-com bubble being unique because of the euphoria and the greed around tech stocks and the tech bubble, and 07-08 because of the inherent risks that we were experiencing in the housing market. So if we exclude for those two, then we're looking at a 15.65% return on an average basis 1 year later, with 100% probability for the markets to be, of course, higher 1 year later. Because if we look at the probability here, so if you try to calculate this number, and we copy and paste it down here. But since now our observations are going to drop to only 10 observations, and I believe all 10 of them are profitable. So we got one here, two, actually one of them is still negative in 1981, and everything else is green. So we can pretty much do 9 divided by 10, so 90% probability for us to be green 1 year later if we exclude for the dot-com in 07-08. But if we include for that, again, 75% probability with an average and median gain of 10 to almost 15% 1 year later. So the bottom line is that I think the real question isn't rate cuts and what the markets are going to do, how they're going to respond, because the answers are very clear. The markets tend to not really care that much because we are higher. Historically, it clearly shows that rate cuts and rate hikes alone don't determine market direction. And what really determines direction, in my opinion, is the recession. So if it's accompanied with a recession, then rate cuts or rate hikes doesn't matter. Markets are going to be weaker, and they're going to see themselves or find themselves in a situation where they do drop and they start to pull back. Because as I mentioned this in this over here as well, if you look at just the drops in the market in the S&P 500, when there wasn't a recession, the drops are more contained for significantly less time than as opposed to when we have experienced a recession. The drops are more severe and much longer lasting. So those are some things to keep in mind. This right here is exactly what I just showed you, but in a more visual sense. So S&P 500 returned 12 months after the first rate cut. I'm not exactly sure how they are calculating those returns, because it seems like they are either calculating whatever this source is from, because this was posted in our Discord. But this actually does kind of skip a few months here, because the way I calculated it is that I looked at the rate cut month and then the returns of the next month, starting next month, and then looking at 1 month, 3 months, 6 months, and 12 months out. But even here, you can see that January of 2001 and September 07, so those are the only 2 years when the markets were down 1 year later after the Federal Reserve rate cut. Every single time, every other time, we've seen the markets push higher. However, there was one more instance that I recorded here, which was 1981, and they have 1981 not even listed over here. So maybe they're not accounting for that being a rate cut from the Federal Reserve. So again, I would take that with a grain of salt here. But the bottom line is, yes, the markets indeed perform much better 12 months later after the rate cut. Significantly better if it's not accompanied with a recession. If it's accompanied with a recession, then yes, a little bit less. But overall, very, very strong gains from the market. And volatility also accounting for the VIX. And the VIX does crash over 60%, which is the largest drawdown in a 6-7 day period. The markets are higher 1 year later 100% of the time. So that's also a very, very important metric to keep in mind. So from a long-term perspective, for all the long-term investors, this is indeed a bullish catalyst that is going to lead to quantitative easing and overall some more market momentum higher. But we have to be careful and understanding and prepared of the very idea that recession is still possible in the US. And that's the real question. That's a debate. That's a discussion that we can have on our Discord and on our YouTube, that whether we're going to see a recession or not. I think that's still open for discussion. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available until the end of this month. And as always, happy investing. I'll see you all in the next video.